Hey everybody, Happy New Year. So today I want to kind of walk you through how you can buy a $715,000 home based on a few different scenarios. There's a big myth out there and big misnomer that most people think that they need at least 20% down to buy a home, but that's just simply not true. There's so many ways to buy a home: 3%, 3.5%, 5, 10, 0%, depending on the situation. So I'm going to walk you through all those situations and scenarios so that it gives you an idea, an illustrative idea of how you can possibly buy a $715,000 home. So for today's situation, we're going to be taking this brand new listing that came in this weekend. It's a 21301 China Astor Court in Germantown, Maryland, 20876. It's listed by my good buddy, Kevin Grolig. He's a superstar agent at Compass. He's also a YouTube star, so you can check his YouTube channel out. But, this beautiful property, 2-car garage with a driveway, almost a quarter acre. It has a beautiful island kitchen, and it's almost 3,000 square feet, 4 bedrooms, 3 baths with a half bath. It's a beautiful home. So with this property, we're going to take the situation from this avatar that I created. So Jane and Joe, so they have a 740 credit score. Their annual household income is about $150,000. They are a first-time home buyer. And so let's take a look here. So in this situation, I'm going to take a look at first a 3% down at par rate. Par rate meaning there's no points or lender credits. It's basically a base rate. And so the down payment would be $21,450. And the rate, as of today, it's looking like it's about 5.75. So it did improve compared to prior into the holidays, but 5.75 30-year fixed, APR of 5.819. The mortgage insurance is about $312.10. Okay, there is mortgage insurance because it's less than 20% down. And then a property tax and homeowners insurance is a cumulative about $607.08. So the way I did it is all I did was I went to this website. It tells you exactly what the property tax is. I divided it by 12, and then I plugged in the number. For the homeowners insurance, I know the area pretty well, so I know that the homeowners insurance is going to be roughly around $150 per month. So I plugged that number in there, so a total of $670.08. And then the HOA condo fee, the HOA fee is $59 a month. It was on the website. Now, this underwriting fee, the pro tip here is you're going to pay for it regardless. If you don't see it, it's baked into the rate. No matter what the lender or loan officer or anybody is telling you, it's going to be there. And that's because it's just a fee that the investor or that the lender is going to charge. There's ways on the back end so that when we work on it, you can hide it by baking it into the rate or displaying it. The way I think the proper way to pitch it is, or to share it with the borrower, the home buyer, is to say, hey, there is an underwriting fee of whatever it is. It could be $900, it could be $1,000, $1,050 here, whatever it is, $1,200. But you have the option. Do you want to pay it out of pocket, or do you want to roll that into your rate? And rolling it into the rate means it could possibly increase the rate. So that's going to be kind of the con of rolling it in, but that's an FYI pro tip for you. Now, the rest of these figures, these are just illustrative purposes based on this scenario that I ran. So, your situation, your scenario might be different based on your profile, but just illustratively, I think this is a good ballpark to kind of guess what you might be paying for. So appraisal fees and all these nicks and knacks, it's going to total about $740. It can be plus or minus $50 to $100, but $740. And then when you scroll down here, title fees, when I ran it through our national title provider, it's roughly around $3,200 based on this situation. You can see title insurance is pretty expensive, and this is title insurance for the lender. You're paying out of pocket to insure the lender for title. Okay. And I'm going to come back to this point, that why I'm kind of pointing it out. And then recording fee and taxes, you can see is about, roughly about $7,000, because it's a sizable home, $715,000. So far you will see, besides the down payment, the two largest, and this is typical, okay, the two largest costs are going to be taxes and then title. After that, it's really going to be things that the lender might be charging, or the appraisal, is the second thing, or the third thing that's expensive. And then other things are things that the lender might be charging, as well as the underwriting fee. So the title fee, the lender has no control over, his title company. So don't ask your loan officer, what are you charging with title? They don't dictate it. It's going to be based on whoever the title company is. And obviously, I hope you know that the loan officer, the lender, the title company, they're not charging you taxes. This is based on the state, county. So that's what it's going to be. Homeowners insurance, this is based on you investigating and getting quotes. So that's going to be based on whatever you are able to obtain from a quote for the policy. So again, $150 times 12 is $1,800 is what I'm guesstimating that the premium, the first year premium is going to be. Now here, owner's title policy. Remember I said this title policy up here insures the lender. Well, if you think that the lender thinks, right, it's important enough for you to pay their policy, don't you think it's important for you to get a policy as well for your title? And all this does is it protects you just in case down the road somebody says, hey, title wasn't recorded. This is actually my home. It's not yours. And you got to kind of go through this lawsuit. The insurance policy, this title insurance policy kind of protects you from scenarios like that. That's just one of many. Prepaid interest, this is going to fluctuate depending on when you close. So I would not, if you're ever getting a quote, kind of focus on this number. If you close early in the month, it's going to be a bigger number. If you close later in the month, it's going to be a smaller number. I'm not going to get into why on the calculations and the math, but just know that's in general, that's how it works. Escrow, typically it's going to be 3 months of your property tax as well as your homeowner's insurance. So this number right here, up here, that's going to be times 3. Now, I'm going to come back to this later in a different scenario that I'm going to walk you through. But at the end of the day, for this scenario, the net cash to close is expected to be right around $40,000. Now, it can go up, down, depending on if you are able to negotiate a seller credit. These days in the market, I'm seeing a lot more seller credit negotiations for this, but you do need to get a really good realtor like Kevin in order to negotiate this properly, because it's not just, negotiating a lower, purchase price as well as trying to get the most seller credit. There's some strategy involved, so just keep that in mind. But for a 3% down for a $715,000 home, I want to say it's going to be roughly around $40,000 at a par rate. Now, if you said, hey, I want less cash, I don't have a lot of cash on hand, is there anything else, besides a seller credit? And there is, if you go take this route, this is the same 3% down, a little bit higher rate. And the reason why the rate is higher is, if you can see here, this is the difference right here, that there's a higher lender credit. Now, getting more lender credit means you have to go higher in rate. What you're doing is you're pre-buying this money, okay? Just think of it that way. You're pre-buying this money by going higher in rate to get cash immediately on hand. There's a reason why we got to push this into display this number as a negative, but just trust me, it's a lender credit that's going to basically be used to offset your closing costs. So offset all these appraisal fees, these title fees, your taxes, as well as your escrow amount and all of this stuff. So you can see here dramatically, because the lender credit is higher, the closing cost is everything minus, besides the down payment. The closing cost is almost $17,000 less. And that equates to basically your cash to close. When you go to settlement, it's going to be a much less money out of pocket, right? So that's what you're seeing here. So going higher in rate, if you love the home and you want to go into a home, or maybe you don't love the home, but you need to get a home, right? Or whatever your situation is, you go higher in rate. The payment increase is only about less than $600, which for some folks, it could be a lot. But $600 an increase, but you're getting this big, massive lender credit. Now, do you have to go this much higher? Maybe you don't need 17,000. Maybe you only need 5 or 10. Yes, you can, there's tier steps going in between from 5.75 to 6.99 in this scenario. But, today I'm just going to show you 2 scenarios side to side regarding the situation. Okay. Now, if you had more cash, more assets for a down payment, so let's take a look at 10% down. So I'm going to close this so you can see just side by side. 10% down, rate stays pretty much the same, but you are parting ways with more cash out of pocket because of the higher end down payment. The mortgage insurance drops from $312 to $144. Why? Because you're less risky, because you have more down payment. The lender's going to see you as being less risky, so they're not going to increase your mortgage insurance. Or, out, I guess out in the world, you hear it as PMI, private mortgage insurance, but technically it's just mortgage insurance. Everything else stays the same. So just because the mortgage insurance dropped, your payment drops and the loan amount drops, right? That's why the payment drops as well. So loan amount, mortgage insurance, so your mortgage payment drops. So you can see here a increase of 7% in down payment plus the mortgage insurance drops your payment by I think a little over $400. So it's not as much as you think, but if it's important to you to have the mortgage insurance drop and then start off with a little bit more equity in your home, then this can be an option for you. Everything else, besides lender policy, because the loan amount is smaller, so the lender policy shrinks, is about the same. And then everything else kind of stays the same. And then, your cash to close obviously increases because your down payment increased. Now let's take a look at 15% to see what that looks like. I'm going to do it side by side with the 10%. So you can see up here, again, rate stays the same, but now the PMI or the mortgage insurance or the MI drops significantly. So from 3%, if we take a look here, 3% all the way to 15% down payment, it drops by $275. Is my math right? I'm always using Excel or a calculator, so I can't tell. But yeah, so then when we scroll down here, again, the lender's title policy shrinks a little bit, but everything else pretty much stays the same. And then the cash to close increases because your down payment increased. All right. Now I'm going to show you the 0% down for VA loans. There are other options out there with grants and all this stuff, but I'm not going to get into it because that's just for another day and it's going to get a little bit too complicated. But for a 0% VA loan, still with a 740 credit score, let's say this avatar, going back to here, was a VA or was a veteran and had military benefits, they can go for a 0% down option. Now, the starting rate is about 5.99. If we scroll back up here, so VA loans have no MI, which is wonderful. I mean, they shouldn't, right? I mean, the military vet has served our country to protect us, and they don't need mortgage insurance. This is one of the benefits that they have the right to receive. So thank you for your service if you are a military vet. So no mortgage insurance. Everything else kind of stays the same. There's no underwriting fee because there are all these caps and stuff that the VA pushes. So there's not going to be a underwriting fee. And then also you can see here that some fees are just not there, like this credit monitoring and then the loan title service or life of loan tax service and all this stuff. But you can see there is this big VA funding fee. For a first-time home buyer, it's 2.3%. Subsequent right now is 3.5%. So at 2.3% of the loan amount, it's $16,445. Now with this, you can roll this in and finance it so that you eliminate this as a cash to close requirement. So we can get into that later, but $16,445. Okay. And so down here again, title fee, title policy, but the title company cannot charge a settlement fee per the VA loan requirement. So all these fees are removed, and so now the title policy or the title fees are much less as well. It's about $600 less. There are some additional recording fees, it looks like, for this property for a VA loan. So the tax is increased by roughly $2,200. And then everything else stayed static. So cash to close for this VA, if they were paying this funding fee out of pocket, would be $35,762. Now, if they were going to finance that in, 35,762.47 minus, and then we go up here because they're going to be financing that in. Nope, that's the wrong figure. So it's 16,445. So cash to close could be 317 and 47 cents. Now I am working with a vet right now, and what they were able to do was negotiate a sizable seller credit for the purchase of their property. And with that, what's going to help them, and they were able to get almost 6%. So let's say it was like 5% of the purchase price, right? So 5 times up here the purchase price. So I would have to do this as a minus. So the math works. And you can see here in this scenario, if the VA didn't finance this in, they would be paying $12.40 to at settlement. So if they did decide, so the question you might be asking is, what if they financed this in and reduced it from that 35 to the 19? Now, keep in mind, financing it in means increasing the loan amount, which means that the payment would increase. But, I'm going to just make sure that you understand that, that math, right? Financing it in means increasing the loan amount, which means increasing the principal and interest, this number right here. So just keep that in mind. But if they were financing it in and we reduce this number to 1940, so I'm going to copy and paste this. Now they would have 16,432 left over, which is too much. So what they could do is they could pay off any credit cards if they had any credit cards. They can buy down the rate if they wanted to buy down the rate. So I mean, it's a very great way to use the seller credit that they negotiated. So that's something that's beautiful, benefit that I hope a lot of vets out there are utilizing, because it is a beautiful benefit, and that you get to pretty much negotiate really strongly right now in today's market. So now for this FHA scenario, it's going to be, I dropped the credit score to 640. And the reason being is, for most clients, I'm not going to be recommending an FHA. It's going to be very specific situations. And typically it's going to be two. One is either their credit score is a little bit low and they need that credit leniency, or they need a little bit higher in a debt ceiling or a debt to income threshold because of the fact that they might have a little bit more debt than usual. And so those are typically going to be the two types of situations where I'm going to be recommending an FHA. Now here, with a 640 credit score, everything else kind of staying the same for this avatar of Jane and Joe of $150,000, but 640 now, first time home buyer. For this home let's go back here, at 21301 China Astor Court, 3.5% down is the minimum that you can do for an FHA. And the main two differences are going to be here. The mortgage insurance is going to be a lot higher, $629. And then there's going to be this upfront mortgage insurance premium, which you can finance in similar to the VA loan, but it's out there. So it can be up to $12,074. Now, rest of the scenario, again, these are illustrative, so you can just take a look at it. But if you weren't financing that upfront MIP, the mortgage insurance premium, now you're looking at a net cash to close of $56,000 or $57,000 roughly. So FHA 640 credit score, 3.5% down, cash to close expected is roughly around $57,000 for this $715,000 home. So hope this was helpful to illustrate some scenarios for you, so it kind of gets you an idea of what's possible and what you can do. It's not just 20% down. There's 3%, 10%, 15%, obviously 20% bread and butter, 0% for VAs, and some seller credit uses to get to zero cash to close or zero money out of pocket, as well as an FHA with a low credit score. So if this was helpful, smash that like button. Hope you can subscribe. And then if there's any questions, if there's any scenarios that you want me to run through for you personally, feel free to comment below, and I'll leave my number as well as my email in this video so that you can kind of contact me if you have any questions. All right. Thanks again. Have a great day.